Welcome to Trading an Edge, the show where we break down the psychology, mindset, and system of elite trading.
Hey there. Today, we're really going to dig into something huge, a silent saboteur that impacts literally every trader.
Loss aversion.
That's the one. It's this bias that quietly shapes how you trade, often turning, solid strategies into just pure emotional reactions.
And the goal today?
We want to give you a clear blueprint, how to understand it, how to spot it in yourself, and crucially, how to master it to get back that clarity, consistency, and control.
Okay, so let's kick off with what feels like a pretty disruptive truth. Most traders maybe don't want to hear.
Yeah, it's fundamental though. Look, most traders don't actually lose because their setups are bad. They lose because they just can't emotionally handle the act of losing.
It's personal, right? But there's actual science.
Oh, absolutely. Clinical research is starkly clear on this. Your brain feels the pain from a financial loss about twice as strongly as it feels the pleasure from an equivalent financial gain.
Twice as strongly. So losing $100, it feels like a $200 hit emotionally.
That's exactly it. Think about that imbalance. Gaining $1,000 feels good. Losing 1,000, it feels like you've lost 2,000. That massive emotional weight is what drives so much irrational behavior in the markets.
So when you hesitate, or jump out too early, or hold on too long, it's not necessarily a lack of willpower. It's this clinical imbalance working against you.
Precisely. We define loss aversion clinically as this deep psychological bias. It makes you prioritize avoiding any loss over actually pursuing gains. It's wired in.
And if you don't manage it.
Well, it almost guarantees irrational decisions. And in trading, irrational decisions just, they drain your capital. Simple as that.
But why? Why is this fear so powerful when we're just dealing with, like, pixels on a screen? It's not like a lion chasing us.
Right, but it goes back to our evolution. Our brains are fundamentally wired for survival, not for calculating probabilities in financial markets.
Yeah.
Think about it from an evolutionary standpoint. Losing resources, food, shelter, whatever, could literally mean death. So your brain hasn't quite caught up. When you face a financial loss, it doesn't just see a number. It perceives a threat. A genuine threat to your well-being.
So it triggers a primal response.
Exactly. And the neuroscience is fascinating here. Losses directly trigger the amygdala. That's our ancient fear center.
The fight or flight part.
And it basically hijacks the prefrontal cortex, the part responsible for logic, planning, strategy. That amygdala activation makes the loss feel way bigger than it is, causing this intense emotional flood. That's why you feel that gut punch, that panic, when a trade moves sharply against you.
That explains the physical feeling too, right?
Yeah.
The racing heart, the cold sweat.
Absolutely. It's physiological.
So if this response is hardwired, millions of years in the making, how do we actually beat it? Can we just think our way out of this deep-seated fear? That sounds unlikely.
That's the million-dollar question, isn't it? Look, we're not trying to eliminate the feeling. That's probably impossible. The key is changing our relationship to that feeling.
Okay, now.
Think of it like this. Loss aversion is like a trader gripping a burning hot coal. They refuse to drop it. Not because the coal is valuable, but because they're focused on the pain already inflicted, what's already been burned.
So holding on makes it worse.
Exactly. The tighter the grip, the more you resist accepting the loss, the deeper the burn, the more damage you do.
So resistance is futile.
In this case, yes. Detachment, not resistance, is the path. Professional traders, the elite ones, they counter this bias by systematically reframing losses. They don't see them as danger or personal failure. They see them purely as data.
Data, the cost of doing business in a probabilistic environment.
Precisely. Necessary data.
Okay, reframing losses as data is the goal. But let's get specific. How does this bias actually show up in day-to-day trading? What are the concrete destructive behaviors it triggers?
Yeah, it manifests in ways that directly sabotage your strategy discipline. You can sort of group them into two main areas: distorted decisions and messed up risk management.
Let's start with decision-making.
Okay, the classic one is premature exits, cutting your winners too early. It's incredibly common.
So you're in a trade, it's working, maybe you're up 1R profit.
Right, and your plan says aim for 3R. But then the trade pulls back just a tiny bit, maybe to like 0.8R profit.
Yes.
Suddenly you feel this overwhelming urge to just lock it in. Now,
Why?
it's loss aversion in reverse. The fear of seeing that existing profit disappear, the fear of losing what you momentarily have becomes stronger than the desire to actually follow your plan and maximize the win. So you bail out early.
And leave money on the table.
Constantly. And the flip side of that coin is avoiding trades altogether.
Hesitation.
Yeah. Fear of losing, especially if you just had a loss, makes you hesitate. A perfect A-plus setup appears, fits your plan exactly. But the ghost of that last loss stops you. You freeze.
So you miss the opportunity. Not because the setup was bad.
Yeah. But because the potential pain of another loss just feels too great in that moment, you end up under trading, which means you're not even giving your edge a chance to play out over time.
Okay, that covers messed up decisions.
Yeah.
Now, risk management. This feels like where the real damage happens.
Oh, absolutely. This is where capital gets destroyed. And the most notorious one, the one everyone knows, is holding on to losers.
The hot cold grip you mentioned.
Exactly. Your position moves against you, hits your predefined stop-loss level, and you just sit there. You don't exit.
Why not? The rule is clear.
Because hitting that stop, realizing the loss, confirms you were wrong. And the brain hates admitting error. It feels like failure. So you cling on, ignoring the rule, hoping, praying for some miracle turnaround.
The it'll come back to break-even fallacy.
The classic. This
Yeah.
denial, it just delays the inevitable and often turns what should have been a small managed loss into a significant drawdown.
And then, once that bigger loss finally is taken,
Mm.
what happens next often feels like a spiral.
It often is. Loss aversion then fuels the next destructive behavior. Overtrading after a loss.
Revenge trading.
That's the one. It's this impulsive, desperate need to make back the money you just lost. It's your amygdala screaming, trying to fix the emotional pain right now.
So you abandon the plan again.
Completely. You start taking random, high-risk trades that have nothing to do with your edge. It's almost always a guaranteed path to digging a deeper hole, a vicious cycle.
And underlying all of this, there's a psychological trap, right? This feeling that you can control the uncontrollable.
Yes, the illusion of control. You start to believe, maybe subconsciously, that you can outsmart the market, that you can somehow avoid the inevitable losses that are just part of your strategy's statistics.
And that belief justifies breaking the rules.
Precisely. It's rooted in the denial that loss aversion fosters. So, to sum it up, loss aversion makes you cut winners, skip good trades, cling to losers, and chase losses. It's probably the single biggest psychological barrier to achieving consistency.
Okay, so the bias is deep, it's powerful, the sabotage mechanisms are clear. The solution can't be just try harder, it needs structure.
Absolutely. It has to be clinical, systematic. We need a framework to neutralize that emotional power.
All right, let's get into that. The 5-step framework for mastery. What's step 1?
Step 1 is the absolute foundation. Embrace probabilistic thinking. You have to fully, genuinely accept losses, not just intellectually, but emotionally. They aren't mistakes. They are an unavoidable, necessary part of trading successfully.
That sounds simple, but it's tough in the moment.
Yeah.
How do you shift from focusing on the outcome of the last trade to truly thinking probabilistically?
You have to shift your focus entirely, away from single trade outcomes towards the long-term mathematical edge of your whole strategy. This is where understanding your expectancy is vital.
Expectancy. The average you win or lose per trade over many trades.
Exactly. If your system has a positive expectancy, even with, say, a 40 or 50% loss rate, it will make money over time. So your job isn't to prevent the next loss. Your job is simply to execute the plan consistently, the plan that proves that positive expectancy.
Okay, so that acceptance creates a kind of psychological buffer. What's step 2? Sounds like it needs to be practical.
It is. Step 2 is non-negotiable. Set clear risk management rules. This is your frontline defense against that emotional hijack.
Stop losses.
Predefine stop losses. And the key is predefine. You set them before you even enter the trade.
Why before?
Because once you're in the trade, money's on the line, the amygdala is firing, and your judgment is compromised. The stop needs to be mechanical, almost automatic, not something you debate when you're feeling the heat.
Removes the decision-making under duress. What about the size of the potential loss? How does that fit in?
That's crucial. Meticulous position sizing. You have to structure your trades so that no single loss, even a full stop out, can seriously damage your capital or your psyche.
Risking, say, 1% per trade.
Exactly. Risk 1%, and even 5 losses in a row only costs you 5% of your capital. That's manageable mentally. But if you risk 5% per trade, 5 losses wipe out 25%, that's a huge emotional blow, guarantees loss aversion, kicks into overdrive, and likely triggers that revenge trading spiral.
Got it. Control the controllable, which is the risk per trade. Okay, step 3. This sounds like where the mindset shift really happens. Reframe losses as data. How do you actually do that? Make a loss feel impersonal.
You have to consciously view every single loss as just high-quality feedback, an opportunity, not to beat yourself up, but to analyze your execution.
Separate the decision from the outcome.
Precisely. Ask, did I follow my plan? If yes, and you still lost, that loss is just a data point. It's the cost of doing business, confirming your system's long-term statistics. If you didn't follow your plan, well, the loss is still data, but it's data about your discipline, not about the market or the setup.
So it becomes objective information for refinement.
Yes. Treat it impersonally, like a scientist looking at results. Identify patterns, refine your process. It's not a personal failure. It's not an attack. It's just information.
Okay, step 4 feels like the emotional core. Practice emotional detachment. Easier said than done when money is involved.
It requires real conscious effort. Intense focus, actually. You have to train yourself to focus relentlessly on the process executing your plan flawlessly every single time, rather than getting caught up in the volatile, unpredictable outcome of any one trade.
Are there tools for this?
Absolutely. A powerful one is keeping an emotional trading journal. And I don't just mean logging entries and exits.
What else goes in?
You document your feelings, your impulses, the fear you felt before taking a trade, the urge to move your stop, the justification you were making to break a rule before you act.
So you see it objectively first.
Exactly. Writing it down creates cognitive distance. It forces you to look at those impulses more objectively, weakening their emotional pull. It helps break the circuit of loss aversion.
All right. And the final step, step 5. Visualize losses in advance. This sounds a bit counterintuitive. Why would you want to think about losing?
Because preparation dulls the shock. It's like psychological inoculation. You mentally rehearse in detail how you will respond when a loss occurs. Visualize the setup, the entry, the market moving against you, hitting your stop, and visualize yourself executing the stop rule calmly and professionally.
Like practicing for a fire drill.
Kinda, yeah. It's preemptive psychological rehearsal. It builds tolerance. It's similar to exposure therapy. By repeatedly exposing yourself to the idea of the loss in a controlled, low-stakes mental environment, you reduce the amygdala's freak-out response when it happens for real.
So this isn't just abstract thinking. You're suggesting actual practice drills.
Yes. Practical application is key. One powerful method is trade simulation. Use a demo account, or maybe a very small live account, specifically to practice taking losses.
Not just testing setups, but practicing the losing part.
Exactly. Practice executing your stop-loss rule over and over until it becomes an automatic reflex, not an emotional decision point. Another technique is a loss tolerance challenge. Deliberately take a series of very small, calculated losses that are well within your risk rules.
Purposefully losing small amounts.
Yes, to desensitize yourself, to prove to your subconscious brain that seeing red on the screen isn't catastrophic, that a loss is manageable, normal, and survivable.
Wow. So implementing this whole 5-step framework, probabilistic thinking, clear rules, reframing, detachment, and visualization is like rewriting your mental operating system for trading.
That's a great way to put it. You acknowledge the biological reality, the pain of loss is real, it's wired in, but you build systems and mental habits so that impulse doesn't dictate your actions or destroy your capital.
That really sounds like the definition of trading mastery. Controlling yourself, not the market.
That's it. The shift from being an emotional reactor to a clinical executor happens when you genuinely prioritize your process over any single outcome and prioritize your risk management above all else. You stop reacting to the pain signal and start acting based on your plan and probabilities.
Okay, we've gone deep into the psychology, we've pinpointed the sabotage, and we've laid out a concrete 5-step framework to tackle loss aversion. So let's wrap up with that final critical provocation for everyone listening.
Right. Ask yourself this, honestly. Do you trade primarily to win, or do you trade primarily to avoid losing? Because until you stop fearing loss, until you can accept it as just a mathematical part of the process, you'll never find real psychological freedom or consistency in the markets.
Mastering loss aversion really is mastering yourself.
It truly is.
Trading an edge where psychology meets profitability.